understand, what you need to know is that I'm not your lawyer, you're not my client, and you can't sue me. This talk tonight is educational. This is not legal advice. If you hear something tonight that interests you, that intrigues you, that you want to follow up on, what you need to do is either speak to your lawyer, or if you like, come speak to me privately and we could go deeper, but do not take any action based solely on what you hear this evening. Let me tell you a little bit more about myself, since a lot of you do not know me. I am an unusual lawyer. I'm the real estate investor's lawyer, and I'm also a real estate investor. Why is that important? Because most of my clients tell me that one of the main reasons that they retain us and continue to use us is because, since I'm an investor like them, I can better understand their unique needs, concerns, objectives, desires, fears, and I understand their business. They don't have to explain things to me. That is why, if you go to our website, on our homepage, our tagline is, "We understand, we're investors too." In addition, what I do is I provide services in the area of transactions, including everything from entity formation to asset protection, joint ventures, syndication, purchase and sale agreements, loan documents, construction agreements, commercial leases, easement agreements, virtually everything in the cycle of ownership that we as investors encounter, and disputes or litigation that arises in connection with those areas. I have been president of the Marin County Bar Association. I am selected for inclusion in Super Lawyers, which is just for the top 5% of attorneys, nominated by your peers, and I have also been nominated by my peers to have the highest rating in Martindale-Hubbell for excellence and ethics, and also nominated by peers for the highest rating, 10 out of 10 superb, by AVO. I've also been a commentator on TV, radio, podcasts, and news. You may have seen me on Squawk Box on CNBC talking about lawsuits on the rise, and also on Fox News talking about 7 ways to legally delay or avoid foreclosure. In addition to all of that, perhaps the most relevant credential I can cite to you is I'm also a joint venture partner, not only for doing my individual deals, but also I'm part of a family office. 3 generations, I'm the middle generation. Our family office has been doing deals in real estate for over 6 decades. We have developed thousands of units of apartments, hundreds of thousands of square feet of office, medical office, retail, hospitality. We developed and still own the Four Seasons Hotel in Los Angeles. And the result of all that is most of the deals that we have done have been joint ventures. So what I'm talking to you about tonight is not just legal theory. I have walked the talk. I am teaching you things that I myself have used throughout my entire real estate investing career, not only myself, but also my entire family. So I'm here to tell you that one JV deal can set you up for life. Here's another project that we did. We don't usually do smaller deals. This is a single family teardown in Truesdale Estates that we created this gorgeous contemporary building, and this was also a joint venture deal. We got a 200% ROI in 2 years, and this is another deal, apartment deal that I did with the joint venture, and our return on investment was 100% in 2 years. So one of the most important lessons that you need to learn when talking about joint ventures is the importance of being a good partner. That is the single most important thing that will keep you out of disputes and keep you out of court. It's like the Beatles, your partner, if you're in a joint venture, is silently asking themselves throughout the partnership, do I really need this person? They needed you at the beginning, but do they still need you? And so the answer is that you need to be conscious of that, and you always have to be asking yourself what more you can do to be a good partner. I want to read you this nice testimonial that my partner, Hugh Stewart, gave. This is Hugh Stewart wanting to say thanks to Jeff Lerman. He was our partner. We met at an education and networking event. Let me stop there for a second. A lot of you, probably the vast majority of you, have never done a joint venture before. And you might be thinking to yourself, well, I don't know where to begin. I don't have enough experience. So that would be a speed bump to me getting involved in this. I met Hugh at at an event. I heard we had somebody in Boston. There's a great commercial real estate education company called RE Mentor. The gentleman who started it is Dave Lindahl. I'm sure a lot of you on the call probably have been to a Dave Lindahl event. I think it's one of the finest commercial real estate education companies in the country. I teach his private money bootcamp. I've done it for several years. In any event, I met Hugh at one of those events, not just the one I was speaking at, but I go to his events anyway, just for the networking. And Hugh had never done a joint venture before. He had done other things, but not a joint venture. But we met, we instantly had a rapport, and he told me he had a deal in Nashville that was interesting. We went, we had a drink. Long story short, 30 days later, I was in a partnership with him, a joint venture with him, and we did his deal together, even though it was his first joint venture deal, and it was actually his first multifamily deal. So just because you haven't done a particular asset class before, I know a lot of you might be used to doing fix and flips or smaller deals, you can get started in this. If the deal makes sense, there are people out there like me who are looking for people like you. In any event, so Hugh wrote here, we met at an education and networking event, and he came to the party with about $900,000 and a lot of experience. His litigation experience helped us save our deal when it was in trouble, and has been a pleasure negotiating with him as a fellow partnership expert. I'd like to say thanks so much to Jeff, and I can't wait to do our next deal together. I just had a conversation with Hugh a couple days ago, actually. It's been a couple years since I saw him. And here's another partner, Christian. Christian's 20, at the time we did this joint venture, he was, I think, 25 years old. And he writes, Jeff has been a joint venture partner of mine for 2 years. It's been a great experience to work with him, and one that has made for several successful deal structures. Together, our JVs have increased profits over 150% in the last year alone. I credit Jeff's long track record of successful partnerships, as well as his deep understanding of how to allow each individual's respected attributes shine into the bigger picture. Jeff, it's been a pleasure doing business with you, and I look forward to many more years of successful deals together, your friend and partner. So that's what you want to have your joint venture end up as friends, and hopefully friends for life. And that's the mindset that you want to come into these deals with. Now, this topic is probably my most favorite topic. I speak on a lot of topics, but I'm passionate about this, again, because it's something that I have done so much as a businessman. I love being able to combine that experience with legal. And as a additional thing that I do because of this, I created a group on LinkedIn. And the name of the group is Real Estate Joint Venture Matching Group, Find a JV Partner Here. That's the title of the group. I wanted to be really clear that what the purpose of this group was. I formed it back in 2012. And as of a couple of days ago, we had over 5,000 members in the group. So it's a great way for you to meet new potential joint venture partners or people looking for joint venture partners, and it's 100% free. So I encourage you to join that group. And if you ever happen to be in my neck of the woods, which is downtown San Rafael in Marin County, stop on by our building and say hello. We're right there in Central Business District downtown. We also have branch offices throughout California, and we also represent, I know we have a lot of people here who are not residents of California. That's okay. We represent clients all around the country in setting up their joint ventures. So if you are interested in this topic and you don't have an attorney that can help you with this, give me a call and we can help you. So let me tell you what we're going to be covering in the time we have together tonight. We're going to talk about your biggest challenges, why this is so important for all investors, the biggest problem with using OPM, the biggest problem with syndication, the JV solution, the difference between a joint venture and syndication, why I believe JVs are the cheapest, easiest, fastest, and safest way to do OPM deals, how to find a JV partner, steps for a successful joint venture and minimizing the risk of partner disputes, the biggest warning sign you're headed for a lawsuit with your partner and how to handle it, and Stay to the end because I have some very special gifts for all of you, and I want you to not miss those. So please stay. As for those of you who may have joined late, as Bobby mentioned, my portion of this will go for an hour. We're already a few minutes into it, and then we'll open it up for Q&A. And the Q&A, to do that, go ahead and send your questions in through the chat or through the Q&A, and Bobby will collect those and we'll talk about those later. To get a copy of these slides, just send me an email to jeff@lermanlaw.com. It's jeff@lermanlaw.com. Type slides in the subject and we will get you a copy of these slides. Don't worry about taking notes on everything. Just listen and pay attention. So finally, before we jump in, I want to make sure everybody understands this is not just about getting money. Joint ventures have huge benefits besides just getting access to other people's money. This article that was printed in the Wall Street Journal not too long ago did a great job of discussing that, and I have this excerpt. It's such a great excerpt. I want to read you the entire excerpt verbatim because I need to hear all of it. A growing player in the real estate market is the so-called family office, in which an ultra-high net worth family, typically with more than $100 million in assets, joins with another wealthy family to buy investment property. Despite having ample cash, I'm going to read that part again. Despite having ample cash. So you got two families, high net worth families that have over $100 million in assets. They're not doing this for the money. So why are they doing it? Despite having ample cash, these families are looking for partnerships in order to lessen their exposure to risk. If real estate values were to tank, for instance, losses would be spread out over at least two parties rather than one family incurring the entire hit. We'll go deeper on that a little bit later, but get that, to reduce your risk. Some family offices with expertise in housing look for partners that have built their wealth in other sectors. That's another reason to partner up with somebody who has expertise in a sector that you don't. Others seek out real estate investors with a similar background in order to combine their expertise. So you're going to partner with somebody because they know something you don't, or just because you want to partner with somebody else who has the same expertise as you do, but to combine your expertise. And partnering up can help a family office get regional diversification. So maybe California is not the best place for you to invest, but someplace in the Midwest is, and so that would be a great way to diversify. That way, if a market takes a turn locally, the families still have rental income from other locations. This one slide probably is the single most important slide for you to understand why this is a topic that you need to know about. So, having teed it up, my question for you is, what keeps you up at night? Specifically, what's your biggest challenge as a real estate investor? We were talking earlier about the fact that this is a strategy that's not for someday in the future. This is a strategy that I really want to talk to you about now because it has great relevance now. So if you currently own your own commercial real estate, and when I say commercial real estate, I'm talking about multifamily, offices, industrial, whatever your property happens to be. So is your biggest challenge that your tenants aren't paying rent, that they can't afford, that you can't afford to pay your mortgage because your tenants aren't paying rent, that you can't afford to pay your expenses because your tenants aren't paying rent? I'm telling you, on my apartments, we're going through some of these challenges now. We're dealing with it day by day. You can't afford to keep your current properties, or the failure to pay can result in severely reduced credit score. These are some of the reasons, the most important reasons why people with current real estate are up at night. They can't get this out of their head. These are problems that are going to have a big effect on you, on us. Or is your challenge that you want to take advantage of some of these commercial real estate opportunities, but you don't know how? I had a client come to me just the other day, and he asked us to put together a fund so that he could raise the money because he wants to go out there and start going after some of these opportunities right now and have a war chest that he has at the ready so that he can negotiate more aggressively. A fund is a syndication. What I'm going to teach you tonight is how to do that without doing a fund, doing it with a joint venture instead. So For those of you who are looking to go after these deals right now, what are your biggest challenges? Is it that you're too busy with your day job to prospect for deals? That's my single biggest challenge. I'm too busy as a lawyer to also go out there and look at 100 deals to find one that makes sense. That's one of the reasons I do these webinars and go teach at these events, and I network to find other people like you to increase the deal flow so I could find more people who've already done the deal, found the deal, and they've done their due diligence, and then I can come in and I can joint venture with them so that I don't have to spend all that time looking at 99 deals that don't make any sense. Is the challenge that you can't find that needle in the haystack investment that makes economic sense? Some people have that skill, others don't have that skill as much. Is your challenge that you're fully invested in other deals? We'll be talking about that in a little bit as well. That you don't have a proof of funds letter to have your offers taken seriously, that you have bad credit, that you can't qualify for the loan you need to buy properties, or that you just don't have the down payment to buy new properties. Whatever your challenge is, I believe that joint ventures could be the perfect solution. So let's talk about it. There are two main experiences that I've had in my life that made this a topic that I had to teach. I had to get in front of groups like you and explain. One of them is when I was actually teaching a Lindahl private money boot camp. But this happens every time I teach syndication in front of a room full of investors. Invariably, what happens is when I complete the session where I'm explaining the securities laws, invariably, at least one, usually more, investors comes up to me at the break, and he or she asks me a question with fear in their eyes. And the question they ask breaks my heart, the fact that they're even asking me that question. I want to make sure that you never find yourself in that position where when you go to a syndication class, boot camp, whatever, and you learn for the first time what the challenges are in syndication, and you came to that event usually to find an investor for your next deal. That's why you're there. And then to learn what I'm about to teach you and learn it for the first time then, I don't want you ever to be in that position. So I want you to listen very carefully to what I'm about to teach you, because this is the lesson that I teach to them that gives them the fear in their eyes. The biggest problem with using OPM is the SEC, Securities and Exchange Commission. Not necessarily them, but the securities laws themselves. Because when you're doing a syndication, you cannot avoid having to comply with the securities laws. The most important rule to make sure you raise money in compliance with the securities laws is this, that before you can pitch your OPM deal to anybody, you must have a, quote, pre-existing substantive relationship. Okay, those are two very important terms, pre-existing substantive relationship with the offeree, the person you're pitching it to. That's the magic language that you have to comply with. So let's break that down. What makes a relationship pre-existing? According to the SEC, a pre-existing relationship is one that the issuer, that's you, has formed with an offeree, that's the person who's going to be your investor, prior to the commencement of the securities offering. Prior to the commencement of the securities offering. So that language that I put in blue requires us to go again deeper and ask, okay, what is commencement of the securities offering? When is a commencement of the offering? An offering is deemed commenced once a deal is contemplated. For example, once you sign on the dotted line on that purchase and sale agreement and you put that property under contract, you have commenced the deal. After then, if you pitch your deal to somebody that you don't have a pre-existing relationship with, it's too late. It's too late. So everybody, if you go to one of these events, a syndication event, hoping to find your next investor, and 99% of the people in that room you've never met before, then you can't talk to any of those people about your deal, because if you do, then you have tainted your entire deal. You can't syndicate it anymore because you've made an offer that's not in compliance with the securities laws. Let's talk about that word substantive. What makes a relationship substantive? According to the SEC, a substantive relationship is one in which the issuer or a person acting on its behalf, which is usually a broker-dealer, has sufficient information to evaluate and does in fact evaluate a prospective offeree's financial circumstances and sophistication in determining his or her status as an accredited or sophisticated investor. We don't have time to define terms like accredited or sophisticated now. This is not a seminar about syndication, it's about joint ventures. But just understand that if you have not, before you pitch a deal to somebody, already determined that they have understanding what their financial circumstances are and their sophistication before you pitch them a deal, then again, you have violated the securities laws. The consequences of violating the securities laws is that a court can find you guilty of violated securities laws, and they can order restitution, meaning that they could order you to give back to your investors all the money that they have given to you. And I will tell you this, I've never seen an investor complain when the deal has gone well. An investor usually only complains when the deal has not gone well. And if the deal has not gone well, the last thing that you're in a position to do is give them back all of their money. So you never want to be in that position. And the other thing that's important for you to understand if you violate the securities laws is there are potentially criminal sanctions as well. Can you say Bernie Madoff? So between the restitution and the potential criminal violations, this is, the stakes on this are really, really high. It's serious. You want to make sure that you take securities compliance very seriously. So after I explain that in front of the room, invariably this person, an investor, will come up to me. And again, remember, they came there specifically because they were going to try to find people that they could pitch their deal to. And they say, I have a deal under contract now. I need money now. What do I do now? Although they usually don't look this calm, they usually look more like this. And not to make fun, but it's serious. When somebody has already had their money go hard on a deal and their only salvation is to go to an event, a syndication event, to try to find strangers that they can get to invest in their deal, that is a very stressful thing. I mean, these are people who have hundreds of thousands of dollars, sometimes maybe even more, already hard on the deal. And if they can't get the money they need, they're going to maybe have to walk away from those hard earnest money deposits. So I never, ever want to see you in that position. So the solution to this problem, I believe, is joint ventures, but not just joint ventures with the right partner, but not just joint ventures with the right partner, joint ventures with the right partner that have been properly set up. So let's talk about what that's about. What is a joint venture? Because a lot of people don't even understand what a joint venture is. When I say syndication, people think that's a joint venture, and it is. But even though not all syndications are joint ventures, but not all joint ventures are syndication. So let me explain. When I'm talking about joint venture, I'm talking about the coming together of two or more people who are actively engaged in the deal. Actively engaged in the deal. So let's talk about what actively engaged means. According to the California Corporations Code, and again, I know we have people listening who are not in California, that's okay. Odds are that your state has similar legislation. According to the California Corporations Code, a security means any participation in any profit-sharing agreement, interest in a limited liability company, except a membership interest in a limited liability company in which the person claiming this exception can prove that all the members are actively engaged in the management of the limited liability company. So they're saying that it's not going to be deemed a security if the person can claim that the members are actively engaged in the management of the limited liability company. But the language that follows this that I highlighted, not highlighted, that I put in red is equally important, because invariably somebody says, okay, that's great. So I will just draft the operating agreement for my LLC to make everybody, give everybody a vote in management. And then I can say that everybody is actively engaged in the management of the limited liability company. It doesn't work like that. So this language that follows says, provided that evidence that members vote or have the right to vote or the right to information concerning the business and affairs of the limited liability company or the right to participate in management shall not establish without more that all members are actively engaged in the management of the limited liability company. So you need to be actively engaged. Let me give you a quick example of what actively engaged looks like, because that is one of the most common questions I get. So I did a joint venture deal. It was a residential subdivision development deal. And there were 4 people in the deal, 4 partners. One of them was the guy who found the deal. And he's also the guy who got the loan. And one of them was the developer. And one of them was a broker who was involved with the design and the marketing of the completed product. And I came into the deal with the money. So each of the 4 of us had a separate but material and necessary role to play in that deal. And so all of us were legitimately actively engaged, but it doesn't end there. What we did is we all lived in separate cities. We all got on the phone, a conference call once a week. We had one person was the secretary for that call, took notes on everything, took minutes of the meeting, and we had minutes of every meeting where whenever somebody brought up an issue or made a comment, the secretary took notes, wrote it down. And so if we ever came under scrutiny by the SEC, that would be Exhibit A to prove not only were we all actively engaged because of our unique roles, but the comments that were made during these meetings were all right there in notes that we could prove it. So that's an example of how you can set it up so everybody is actively engaged. But you're never going to know that for sure. It's always going to be a question of fact. That's why you need to get with your lawyer or get with us when you're setting this up, because one of the first things we need to do is help you determine if you are, in fact, all actively engaged, because that is one of the biggest mistakes I see people make. They think what they're doing makes them actively engaged, but they're really not. So you also need to have experience in real estate or business, as much experience as the person who has the least amount of experience in the joint venture. And you cannot be relying solely on somebody else to make you a profit. So that goes back to not being a passive investor. You want to be actively engaged so that you're having an impact, a material impact on the outcome of the deal. What this is not about is partnerships with passive investors. That's a syndication. When all you're doing is, when you're taking a check from somebody and they're relying upon you to make them a profit, that's a passive investor. This is not about syndication. This is not about securities laws. That's the last we're going to talk about, the securities laws. So let me explain why I believe that the cheapest, easiest, fastest, and safest way to save your deal and overcome your challenges and finally reach your success goals is a joint venture. The cheapest, I believe, is the cheapest because literally JVs will save you thousands of dollars in legal fees over syndication, thousands. So for that reason alone, even though I make a lot more money if I'm helping somebody do syndication, the first thing I'll do with somebody when they talk to me about doing a syndication, I'm going to tell them what I've been telling you. I'll say, look, I'm happy to do it, but my plan A, when I do a deal, isn't syndication, it's a joint venture. So, and sometimes you can do joint venture and syndication together. That's a more complicated discussion. We could talk about it later. But JVs will save you thousands of dollars in legal fees over syndication. But in addition, everybody has a finite amount of financial resources. At one of these events that I was not speaking at, again, networking at, I was talking to a gentleman before we went into the meeting, and I talked to everybody there. I just, that's why you're at a networking event, just really to get to know everybody. And I was asking him about his investing career and what kind of deals he does and what kind of deals he has. And he had about 8, 9, 10 deals, a lot of deals, and it was very impressive. And I said, wow, that's really impressive. And I said, so what kind of deal are you looking for here? And he said, well, I'm not really looking for deals. And I said, well, then why are you here? And he said, well, I'm not, I said, why aren't you looking for deals? And he said, because I'm fully invested. And I said, well, you're fully invested in 8, 9, or 10 deals. So what you could do is you could do a joint venture, even though you've already got the deals. As a matter of fact, your position, your pitch to a potential joint venture partner is even better than somebody who doesn't own the deal, because you believed in the deal enough to put 100% of your own money in. It's no longer a pig in the poke. You've seasoned the deal, you know the deal. And so if you pitch that deal to a partner to come in, that's a pretty interesting proposition. So what you can do is you can pull money, your money, out of your deal, and you could be here, instead of just getting education, you could be trying to find the next deal to do with the money that you pull out of your properties. And I could just tell when I was talking to him that the wheels in his mind started churning, and he said, wow, that's really an interesting idea. As a matter of fact, he left a nice note on my LinkedIn profile after that. He said, I had the opportunity to discuss our real estate holdings with Jeff Lerman in Boston, where he was a special guest speaker at a real estate business event. In just a few brief moments, Jeff was able to assess my business model and open my eyes to the extraordinary use and leverage of joint venture partnerships. I never would have imagined establishing the structures Jeff was able to explain in easy to understand language and to create the potential for growth beyond our imagination, within our grasp. It was right in front of us and never even knew it was there. Jeff, I can't thank you enough for your insight, clarity of concepts, and creative ways your mind works to help build better businesses for your clients' continued success. Thank you very much, Brian. It was a pleasure meeting you as well. So this is why I say what you can do with the joint venture is you can use your limited financial resources to seed more deals, instead of putting all your money in all deals and just waiting for some time in the future to sell those deals before you can get another deal. This is the way that you can grow your portfolio faster, by putting less of your money in a deal, bring a partner into your deal, and then you'll have twice as much or more to go out and buy other deals. Why do I say it's the easiest? Because think about it. We all know this, we're investors. There's so much to do as investors. You have to sift through dozens of deals to find one. You have to analyze the deal. You have to do the due diligence, find the loan, deal with the lender, find the money, manage the asset, manage the manager, and ultimately sell the property. And those are just the things I could think of off the top of my head. We all know it. There is so much to do that could be so intimidating that for some of us, we don't even bother. We just give up and go back to our day job. And so it feels like the weight is on your shoulders when you are doing a deal all by yourself. But with partner power, if you have somebody else who is equally sophisticated like you to help out carry that burden, all of a sudden that globe feels a lot lighter and you can manage it and you can do more deals. Fastest, I say the fastest because, again, thinking about my friend Brian Lucier, if he wants to build his portfolio faster, he doesn't have to wait to sell a property before he can pull the money out to do the next deal. He can pull the money out now and he could build his portfolio faster. Safest, why do I say the safest? Because this is investing 101, diversification. We heard about that in the Wall Street Journal article. Which is safer, putting all your eggs in one basket or diversifying into several different baskets? We all know the answer. So how can you diversify? You can diversify by asset class. So for example, you can go conservative risk and go with apartments, middle risk office, or high risk land. You can diversify by geography. Again, the Wall Street Journal article talked about this. You could diversify by risk. Let me tell you another case study. This is another great example of a benefit that we haven't even heard about yet that's important for you to understand. I have a client who had a property under contract right at the end of, it was 2012. 2012, last quarter, I think it was November of 2012. And he came to me and he had a deal that was under contract. It was a short sale. and he had not yet closed on it, and he was concerned because at that point in the recovery, we didn't know when we were going to recover. We didn't know how long it was going to last. We were already 5-6 years into it, and we weren't sure how much further down is it going to go. And so my client said, I don't know, even though I'm getting a good deal, it could get a lot worse. And I said, look, if you're about to walk away, before you walk away, why don't you find somebody who could be a potential joint venture partner, somebody sophisticated, and talk to them about the deal and get a second opinion. Don't get a second opinion from the broker who brought you the deal, who's got a bias. Apologies to brokers, but a broker does have a bias on a deal that they already brought to you. Don't talk to a consultant. Talk to somebody who's going to put their money where their mouth is and invite them to the deal. And so he did that, and as a result of talking to that other person who was more comfortable with the risk, my client went ahead and he went forward and bought the property. Well, for those of you who might remember, so they closed the deal in December of 2012. In January, that's when we hit bottom. January, like the next month, and that's when the market started to come back. 6 months later, that client's property was worth twice as much as what he had paid for it. Now, that ending is almost irrelevant because it really doesn't make a difference if it went that way or if it didn't. That's not the point of the study, the case study, and that's not the point that I want you to get. What I want you to get is that what having a joint venture partner can do is it gives you a second perspective. And for all of us in real estate, your gut instinct is a huge component of how successful you're going to be. And some of us are more conservative than others, and that's good to see where you should be. My gut, I'm one of the more conservative investors out there, but I'm one of the more aggressive lawyers when it comes to risk, because most lawyers are hardwired to just focus on what can go wrong, and they don't take any risk at all. I take some risk, but not as much as others. So it's really great for us to be able to get that input from somebody with a different risk level and risk tolerance level, so that we can become more sophisticated investors ourselves. So you get that. And then the nice thing is that whatever decision my client made, whether he went forward or didn't go forward, the fact that he went through that extra step of talking to somebody else whose opinion he respected would give him greater peace of mind that he said, you know what, it may not have worked out the way I wanted to, but I remember why I did it, and I remember that I really did a good job checking it out, and so I feel better about that. And on top of that, now I created a great relationship with somebody where I can do future deals. So the benefits, the case study, the takeaway here for you is additional benefits of joint ventures. Number one, to get a second opinion from an investor who's able to put his money where his mouth is, as opposed to just getting opinions of consultants. Number two, getting credible input to help you reevaluate your risk assessment for this and future deals. Number three, getting the deal done instead of passing, or making you feel better about passing on the deal if that's your decision. And a new relationship that will get you more deal flow and more done deals. Those are all huge, huge priceless benefits in this business. And also better risk diversification in your portfolio. Because what he did with that partner, and the reason he wanted to bring the partner is, he says, okay, great, let's do it, because this way, if it tanks, at least I'm only getting burned 50% as much as I would be burned if I did the whole thing myself. So huge, huge benefits. That's, for all those reasons, that's why I believe joint ventures can be the key to your success in this business. So you're asking yourself, that's all great, Jeff. How do I go about finding a JV partner? Let me tell you. Who do you know who has significant money and is sophisticated in real estate? Well, you know Bobby Sharma, and now you know me. So there's two right there. But in addition, who else can you think of that could be a good joint venture partner? You could talk to your real estate lawyer, or anybody who's a real estate lawyer, even if they're not your lawyer. You talk to CPAs, real estate brokers, RIAs, and meetups. That's a great place for you to find somebody who's interested in doing joint ventures. Family office conferences, great place to find joint venture partners, friends and family, and join that LinkedIn group I told you, Real Estate Joint Venture Matching Group. Find a joint venture partner here. This is just the beginning, but go to the people that are wealthy who you give money to. Go to your doctor, go to your lawyer, go to your CPA. Those are people who already believe in you. Now, I bring up this Wall Street Journal article one more time because there was a sentence here that I left out when I last read it to you, and I want to put it in, and I want to talk to you about it. The sentence is, after explaining how it was so great, the Wall Street Journal said, correctly so, still, experts caution that such partnerships are fraught with risk. And that is true. Partnerships, like real estate in general, has risk. So let's talk about that. There are a lot of traps for the unwary when it comes to joint ventures. Let me give another case study to prove a point. I had a client, and the client had a partner in 3 real estate development joint ventures over a period of 10 years. They had a multi-million-dollar dispute, which is not unusual in real estate. If there's going to be a dispute between partners, it can be in the millions of dollars because it's real estate. And the issue there was how additional capital infusions should be characterized as loans or capital contributions. Not to get lost in the weeds here, but the issue was my client, had put in money when money was needed in the deal. Even though they were 50-50 partners, my client, the deal needed money, the other guy didn't have it, my guy put it in, and ultimately, when it came to splitting up the profits, at that point, my guy had put up a lot more than 50%. He took the position that was a loan. He took a position that was additional capital contributions, and therefore it shouldn't be split 50-50, but it should be adjusted based upon their actual capital contributions. The other guy said, no, it wasn't a capital contribution, it's a loan, and we should stay 50-50 profits. And so that was what the whole dispute was about. The sad thing is, and this is true in every single partner development litigation matter I've handled, that if the operating agreement had been set up correctly in the first place, this dispute would have never happened. Never would have happened. So the takeaway from here is how important it is to properly set up your joint venture to make sure that you have the best lawsuit protection. If your joint venture, if your operating agreement, if it's an LLC, is properly set up, that's your best protection. The cost of not doing this right, I will tell you that my client in that deal was one of the smartest, most wealthy, nicest people I've ever met. But when I saw him go through this, whenever I deal with a client in litigation, the relationship between me and a client when it's in litigation is war. And when I am working shoulder to shoulder with a client in a litigation matter, I see them under pressure and I see the impact it has on them. And the impact it has on him psychologically, and the guilt that he felt that he could have done something differently, and the fact that he was wasting all this time and money on litigation for something that he just hated it, and it was really impactful on me to see it. I mentioned to you earlier, there were 2 main reasons I want to do this talk. This is the second reason, because I feel like Paul Revere coming back from the front and wanting to shout to all you other people that instead of the British are coming, I'm telling you, you don't ever want to, even though I do litigation is the worst way to resolve a dispute. And I never want you to have to go through it. And the best thing I can do is to help you set it up correctly in the first place. I've been doing this for 40 years. And as far as I know, not a single one of the operating agreements that I've set up, not a single one of the joint ventures I've set up have ever resulted in a lawsuit, let alone a dispute. If they would have, I would have heard about it, because that's what clients would do. They would come back to me if there was a problem. So it's critical to set up the operating agreement initially right in the first place. The cost of not doing this right, lost profits, legal fees on that matter, I'm telling you, we're 7 figures with multi-million-dollar dispute. Opportunity cost, the opportunity cost, not only in terms of the money, but also the time he spent dealing with that. The non-revenue generating time, the physical burden, the stress on the health. the emotional drain, the anger, the self-anger, the frustration, the psychological toll, the self-blame, the distraction, all of this. I never want to see you go through this. If you end up, sometimes you don't have a choice. He got sued. He got sued by his partner. He had no choice. We had to litigate. And if you get sued, you have no choice. But what I want you to do is set yourself up properly to begin with, to not find yourself in that position. So does that mean you shouldn't do joint ventures? No, it just means that you need to understand the risks and take prudent measures to mitigate those risks. So I do a separate talk called 17 Steps to a Successful Joint Venture and Minimizing Partner Disputes. That's a whole other webinar. We don't have time to do a deep dive on that. Let me go through a few, just a very few of some of the most important points of that. So one of the most important points you have to make sure your operating agreement addresses is who will be doing what in the deal. And when it comes to this, just like in real estate, the mantra is location, location, location. When setting up one of these operating agreements, the mantra is details, details, details. The more specifics, the better. So if you're providing services, you want to quantify in time and or dollars what is expected whenever possible. I'm a lawyer. If I'm going to be your partner, we're going to have a conversation about, okay, if I'm going to be providing the legal services, how am I going to be doing that? What kind of a discount? And I'll give a discount to our venture. What kind of a discount am I going to give? I'm not going to let you assume that I'm volunteering and doing that for free, and you shouldn't either. So if you're providing professional services, I know we have brokers on the call, be clear as to whether additional money will be paid for those services, whether you're a real estate broker, a mortgage broker, a lawyer, if you're providing management services. Over and over again, I see clients in a joint venture contribute their services at no charge just to be nice people. I don't want you to do that. It's not worth it. There's too much responsibility and it takes too much of your time. So you should never just give away that free time unless you really think about it and had somebody explain that to you. So whether you're doing property management or asset management, what if more money is needed? Cash calls. There's a tendency for partners at the beginning to believe that whatever they've budgeted for their cash needs, that'll always be enough. And by the way, I'm going to interrupt myself here. Bobby, how much time do I have left on my hour? I want to make sure that I'm on time here.
You have approximately 10 minutes.
Ah, I'm glad I asked.
I want to say 15 minutes.
All right, I'll take the 15.
Because we went long on the initial introduction, so 15 minutes.
Thank you very much, appreciate it. Okay, so cash calls. You need to have a cash call provision, and what you have to address there is, okay, are we going to require cash calls, or are we going to say, no, we're not going to require any cash calls? That's a decision. And if it is required, who decides that more money is needed? What's going to be the procedure if more money is needed? What's going to be the timing when that additional money has to be put in? What are the consequences if there is a cash call default? Does the defaulting partner, if the partner who puts in the money for the partner who doesn't have the money, is that going to be a loan that they're making? And if it is a loan, is that loan being made to the entity itself, or is it being made to the member? If so, what are the terms of that loan? At what point should there be a dilution, like my client in the case study? Should there be a dilution when you have made a loan and 6 months later the other side hasn't repaid it? You have to talk about that. At what point should the venture be terminated? I have a strategy that I give to my clients to make sure that they never find themselves in a position of being obligated to put more money into a deal that they don't want to. So these are all really important details that need to be broken down. These are not boilerplate agreements. These are agreements that require conversation and agreement by the parties. And you want to consider including a representation and warranty regarding financial condition. You want a representation and warranty because if it turns out later that there's a problem and upon further discussion, it turns out that the other side misrepresented their financial condition, then if they file for bankruptcy, that bankruptcy won't save them from having to pay because fraud in the inducement is an exception for bankruptcy. You can't get rid of a debt if the debt was created by fraud in the inducement. Another step, what are our exit strategies? One of the most frequently litigated and one of the most frequently omitted terms, surprisingly, in operating agreements is having a buy-sell agreement. Buy-sell agreement is an agreement where you identify what we call triggering provisions, which if any of these triggering events occur, then that would trigger a buy-sell to take place. So the triggering events, the typical ones are death, disability, withdrawal, expulsion, and bankruptcy. There might be others, or divorce. There might be others that are unique to you, but that's a conversation you should have. And so a buy-sell provision is important because you specify what the procedure is going to be if one of those triggering provisions happens. Litigation risk. Quick story. I had a friend who I hadn't seen in a while, and he was doing a business deal, and he wanted me to invest in the deal. I said, great, let's get together over lunch. And I said during lunch, I said, it's been a while since we've stayed in touch, and I just want you to know that I always do a litigation search on anybody I'm going to be partners with. Just tell me, have you been involved in any major lawsuits? And he said, no, not really. I mean, I got, landlord-tenant stuff, but nothing major. I said, great, okay. So after lunch, I go back to my office, and in about 3 minutes, I pull up what I need to pull up to do a litigation search on him. And I see that he has been a party to 69, count them, 69 lawsuits in which he has been either a plaintiff or a defendant. 69. And so I called him up and I said, you know what? Look, we're friends. We're always going to be friends. There's no way that I could ever be in business with anybody. And by the way, he's a lawyer too, in addition to being a real estate guy. So there's no way I could ever do business with somebody who has either been sued that much or is so comfortable suing other people to resolve their disputes. So let's stay friends. I'm going to pass on your deal. So that's something that you want to do for all of your joint ventures, is you want to do a litigation search. And you want them to represent and warrant what their prior litigation is, any claims, past, pending, or threatened. Finally, the biggest warning sign that you're headed for a lawsuit with your partner, this is not a step that you want to take before, but let's say you're already in a joint venture. For those of you out there, I want to make sure you understand this. A joint venture is a business marriage, and like a marriage, the biggest warning sign you're headed for a lawsuit with your marriage partner is a breakdown in communication. Another quick story. I had a client call me one day. I represented both of them in setting up their joint venture. And he said, hey, so-and-so, my partner, I got to the office and my partner changed the locks. I can't get in. And I said, why did your partner do that? And he said, because he told me that this is what he had to do to get my attention. I got news for you. You don't need to have your partner change the locks on your door before there are warning signs that you have a communication breakdown. I've had partners where I've started to have issues, and I feel it, I see it, I note it. My partner called me, I said, is everything okay? And I said, you know what? It's not. Let's talk about it. And we talked about it, we got through it, and we're still partners to this very day. We still share deals back and forth. So just because there's a warning sign doesn't mean it has to end in a lawsuit. If you head it off early enough, kill the dragon while it's still small, then you can still recover from it. So step number 17, hire the right lawyer and document your deal properly. That is, again, the main takeaway from this entire thing. Do not do this on your own. Don't pull some joint venture agreement off the internet. You need a lawyer who can walk you and talk you through this whole thing. Now, before we go to Q&A, I told you I wanted to end by giving you some gifts. So I want you to send an email to me, jeff@lermanlaw.com, put gifts in the subject line, and I will send you an ebook, which is 17 Steps to a Successful Joint Venture. This is a transcription of the entire webinar that I did on this topic. And if you get that, that will give you a lot. We only went very briefly for like 10 minutes through 3 of these topics. I do a deeper dive in that. It's really priceless if you're going to be getting involved in a joint venture. I also want to give you another ebook I put together called 12 Warning Signs You're Headed for a Lawsuit with Your Partner. I gave you the biggest, but there are 11 more warning signs. And I will tell you this, that a lot of these warning signs are apparent from the very beginning, which is why when I set up a joint venture, I tell my clients, the best way to do this is both you and your partner come into my office, or we'll do it in the Zoom call these days, because I want to be able to see you guys communicate, because I am more objective and I can tell if there's a problem that maybe you're not catching. But I want to give a few of you an extra special gift. So I'm going to call you my Magnificent Seven, the Magnificent Seven of you. Here's the gift I want to give you. I don't do consults for free. If I did, I would spend all day doing free consults and ignoring my clients, and I have to take care of my clients. So when you come here to me to do a consult, there is a charge for it. However, I'm going to be giving a free action plan consult to those of you who are either ready to start a new joint venture now, or if you're already in a joint venture and you have some issues to talk about. So for example, if you're ready to start a new joint venture now, some of the questions you might have is a joint venture the best strategy for my deal? Maybe it's not. There are others. So it's not the only strategy that I recommend. Depending on what you tell me, I might recommend another. Would my partner and I qualify for a joint venture? Again, you might not know if you're both actively engaged or you're both equally sophisticated. What should be the profit split on joint ventures? That's a very common question I get. How to determine if my partners would be a good fit? Again, that's where I like to do a meeting with everybody. How do I pitch my opportunity to a potential joint venture partner? There is a right way and a wrong way to do it. And the more you know, the more you will be able to succeed when you try to find a joint venture partner. So if this is you, if you're ready to start a new joint venture now, then send an email to me, type ready in the subject line, and then I or my assistant will follow up with you, ask you a couple questions, and determine if it's a good fit. And if it is, then the first 7 people that take advantage of that, they will get free action plan consult with me. Secondly, if you have an existing joint venture and need help with that, some of the typical questions are, okay, I think we may have some problems, not sure, it's not a full-blown dispute yet, it's a potential dispute. Can we talk about it? So we can talk about that. We can talk about how to minimize the risk of litigation, how to resolve your dispute without litigation. Again, a lot of times it's just being able to identify the problems, be realistic with it, and then understand what the procedure is to try to cool things down and get past it. How to go from problem to prosperity, which is what I did with my partner in my joint venture. So again, if this is you, then send an email to me, jeff@lermanlaw.com, type ready in subject line, and we'll follow up with you. But again, this is only going to be for the first, I'm calling them Magnificent Seven. So total of 7 people for these free action plan consults. Now, if you're not one of those first Magnificent Seven, I'm still happy to consult with you, but I'm going to charge you for it. So I just want you to know that. So with that, Bobby, I'm ready for questions.
Yeah, I think your inbox should be full by now. Good. Hey, thanks everybody. Thanks, Jeff. Wonderful information. I picked up some new tidbits myself, so thank you very much.
Sure.
We do have several questions. So I'm going to start with Daryl Crabtree. Is there a way to buy multifamily without any money with a JV? I'm an undercapitalized veteran on a VA check. So I think you kind of covered that. I mean, the answer is yes. You can.
Yeah, you can. And actually, but besides just saying you can, that's actually one of the more common joint ventures. We see it a lot. And a lot of times it happens with somebody finds a deal, doesn't have the money. So they find, they got the guy who sweat equity, whether finding the deal or maybe the sweat equity is because the guy also happens to be a contractor. If we have contractors on the call, this is a great strategy for you. If we got, I know we got brokers on the call, it's a great strategy for you. Anybody on the call, mortgage broker, real estate broker, lawyer, anybody who is already looking at deals, that's huge value. I mean, so yes, that's something that can be done.
Yep. Okay. From Neil, what is the average number of partners that you recommend in a JV?
Great question. So I gave that example of a 4-person joint venture that I was part of. That was a development deal, a residential subdivision development deal. There are obviously different levels of complication when it comes to deals. So for example, the other end of the spectrum, let's put residential subdivision development deals, any construction project, over on this end at the high end of, you can have more people involved in that because there's so many aspects of it. We could have had another partner who was a contractor in that one. We could have had, we probably could have squeezed in one other person. However, if all we had was a land deal, which is you buy land and that's it, and then you just wait for it to end up, 20 years later being worth more, whatever, it might be harder to justify that actively engaged component. So it's always going to be a question of fact. I'm not saying it's impossible, but the less there is to do, the more difficult it is to make sure that you can paper the file to survive a examination if it ever comes under the microscope as a true joint venture. So it's always, that's why it's always going to be a question of fact, and you need to talk to your lawyer, or if you don't have a lawyer, give me a call, let's talk about it, and I'll give you my 2 cents on it.
Got it. We have one more question, which is, so, the question is, do you practice in other states?
So we, yeah, and I mentioned that during the call. We don't do litigation in other states. I'm only licensed to practice in California. However, you can do certain transactions in other states, even if you're not licensed to practice in those states. Joint ventures is one of the transactions that syndication and joint ventures are 2 of the things that we can do in other states. So we have clients all over the country and dealing with syndications and joint ventures.
Very good. Okay.
I got a quick question for you, Jeff.
Yes.
Do you recommend JV partners establish an entity, or do you recommend that they just keep themselves as like individuals?
I think that every real estate investor should be having asset protection. You should not be owning any real estate in your individual capacity. We at some point, Bobby, we should probably do a separate webinar solely on asset protection, because especially right now, there are so many people who, for whatever reason, and I can't believe how often I see this with real estate investors, and a lot of them sophisticated, rich, whatever, and they just, they own property on their own. Right now, with what's going on out there, if you don't have an asset protection plan in place, you need one. But you got to be careful when you set it up, because if you already know that you got a problem, then if you try to set up an asset protection plan, you could be committing a fraudulent conveyance, and that is going to be a problem as well. So again, not the subject of this call, but as long as you ask the question, Bobby, we should do an asset protection talk.
I think we have Michelle, right?
She's not. Yeah, she'll touch on it a little bit, but she's going to be focusing on primarily estate planning. Estate planning she'll touch on a little bit, but when I talk on asset protection, it's a full hour. She's going to be spending 3 minutes on it.
Okay, so we should definitely do that. Greg is asking, Rodney is asking, what is the smallest real estate deal for JV?
Well, again, a lot of people fix and flips. I mean, especially if you're in the Bay Area, fix and flip can be millions of dollars, right? Yeah, no, it can be a single family deal. So yeah, if you're talking about real estate, there really is not much of a downside. It's hard to come up with a deal that's too small to do a joint venture.
Got it. And I think we have Greg, who wants to know what's the average price for setting up a JV agreement. I don't know if you can provide some guidance on pricing to the folks on the call.
Yeah, well, that's better if we talk those details privately. But I will say this: that if it's a two-member joint venture, we have a flat fee. Anything more than two, I can't give a flat fee because the nature of every joint venture is that it's always going to depend on the individuals involved. I've been doing enough of them, so I have enough predictability in a two-member joint venture. Something happens when you get 3 people or more involved in a joint venture where you get all sorts of additional communications, issues, concerns that make it very difficult to come up with a accurate enough flat fee to make it fair for everybody. So, but what I do is when somebody comes to me that has 3 or more, I say, look, let's meet first, and we'll charge for the first meeting. But then at the end of the first meeting, then I'll do my best to give you a flat fee based upon what I know at that point.
Sure. Yeah, guys, reach out to Jeff at least to get a ballpark number for your specific case. Kamal Taylor, what is the typical profit ownership split when the equity contributed to the deal is not split equally between the partners? But I think that's also very specific to each case. But do you want to take a shot at that one,
Yeah,
Jeff?
every deal is different. I mean, we just had that one example. So, the split that you're going to have, if you have somebody who put no money in the deal and somebody put all the money in the deal, the answer to that question is it depends on the rest of the story. What else is everybody doing? So that's any answer I gave to that would be meaningless. It's way too dependent on the facts.
Sure. Okay. From Bruce, compared to 506C, accredited investor for a syndication, besides the legal costs, what are the other benefits of a JV versus syndication?
Well, again, not only the cost, the savings, the huge savings, but also that you're going to go back to the case study I gave you of the client who had the property and was going to walk away because it was at the bottom of the market, but we weren't sure where it was. And one of the benefits there was that you have somebody else that you can talk to and say, you know what, I'm not 100% sure. I think it's a good deal, but I'm not sure. In a syndication, you would never have that conversation with any of your investors. If you're not sure, you shouldn't be asking them for their money. So that is one of and it's unlikely that you're going to get deal flow from your investors. It's possible you might, but you're not.
Sure.
Usually you're not. So those are, I think, the two biggest benefits is having, and also having somebody to share the burden with you. I mean, those are 3 huge benefits. So
Sure. I think the main the point is that depending on each situation, get some advice on what's the best structure for that deal. And very often you'll find that you don't really need to do a full-blown syndication. You could get away with doing a joint venture. So Scott is asking, if I find the deal but have no significant amount of money to put into the deal and I cannot qualify as a loan, who might I use as a sponsor?
Well, there are a lot of people who act as sponsors. those are the same people who might be joint venture partners. So it's really, it's the same conversation with the difference, because if what you are doing is asking them to be a sponsor, and just a sponsor, that's one conversation. If you want them to be a sponsor and be a joint venture partner bringing additional money to the thing, that's a whole other conversation. So there are different variations on the theme.
Very, very true. So yeah, that was the last question. And so I know a bunch of you are on the East Coast. So thank you for staying up. Thank you, Jeff. Thanks, Yana. Loved it. And we'll do these on a regular basis. We couldn't fit everybody into the event today, but we'll do it again. Reach out to me, Yana, or Jeff for any questions. But thank you, everybody. Stay safe. And we'll see you online soon.
Great. Thank you very much.
Thank you, Jeff. Thanks
Thanks,
Yana.
guys. Have a good night.
All right. Bye-bye.